The financial world loves to invent complex narratives to make people feel like they need a PhD in monetary policy just to protect their savings. But the reality of what is happening right now with the secret central bank gold accumulation in 2026 is actually simple when you strip away the noise. Most investors are completely panicking because they have spent the last decade relying on dollar dominance and predictable central bank behavior. But they do not realize that complexity is just a status signal for people who want to feel smart but stay poor. If you cannot explain your investment thesis to a 12-year-old, then you are not actually investing. You are just gambling with your life savings on public networks. We are seeing a historic shift where central banks are moving aggressively into physical gold, while the official reporting data conveniently hides the true extent of these massive purchases. People are looking at this situation and assuming that because their local currency is still trading, the fiat system is perfectly fine. That assumption is completely wrong, and anyone waiting around for the dollar to suddenly regain its former purchasing power is likely going to be waiting a very long time. The institutional gold market is currently in total chaos because global entities are exploiting reporting loopholes in London vaults to move assets out of sight. When central banks lose faith in the dollar, it does not matter what the Federal Reserve says or does during their quarterly meetings, because the structural decline of the fiat system is already baked into the debt math. Regardless, the real secret to building wealth during a macroeconomic shift like this is not trying to time the gold market or guessing which specific day the currency reset happens. True financial freedom comes from embracing a flat, boring, and utterly predictable routine that relies on the absolute law of compounding interest rather than speculative metal trading. I currently manage $150,000 in assets at 27 years old, and my entire strategy relies on keeping things so simple that it almost feels lazy. I keep roughly 20% of my total portfolio sitting entirely in liquid cash, equivalents earning a guaranteed yield between 3 and 4%. While the remaining 80% is automatically funneled into broad market index funds every single month without fail. People love to laugh at index funds because they think they are too slow. But trying to beat the market by trading gold options or chasing volatile precious metal spikes is just a guaranteed way to bleed your principal to zero. The new Fed regime under Kevin Warsh wants to aggressively shrink its balance sheet by trillions of dollars over time, which means they will be actively pulling liquidity out of the financial system. When liquidity dries up, speculative growth stocks and highly leveraged assets are always the very first things to get crushed. If your entire net worth depends on the Federal Reserve keeping interest rates at zero to inflate away your debt, you do not have a financial plan. You have a ticking time bomb. The smartest thing you can do right now is lower your lifestyle inflation, aggressively pay down any variable high-interest debt like credit cards or personal loans, and store your dry powder where it actually yields a guaranteed return. We are moving into an environment where savers are finally being rewarded, with short-term treasury yields providing a safe haven that requires zero effort and zero cognitive strain to maintain. You do not need to stay up until 3 in the morning reading bullion vault logs or listening to talking heads on television. Guess what will happen at the next gold summit? All you need to do is automate your savings. Ignore the temporary volatility in your brokerage account and let the boring discipline of dollar cost averaging do all the heavy lifting for you over the next decade. The market will always find a way to punish people who try to get rich quickly through complex strategies, while quietly rewarding the lazy investor who simply refuses to touch their portfolio during a storm. Stop looking for a magical macro loophole, accept that the currency system is changing, and let your money sit quietly in diversified index funds while you go live your life. It is honestly hilarious to watch the average retail investor scramble every single time a central bank official opens their mouth. They think that by analyzing every syllable of a press conference, they can gain some sort of edge over the institutional algorithms. They buy software packages and subscribe to expensive newsletters just to end up underperforming a basic target date fund. The truth is that the entire financial media ecosystem is designed to keep you in a state of perpetual anxiety because anxious people trade frequently, and trading frequently generates commissions for Wall Street. The moment you realize that your opinion on central bank gold policy does not matter is the moment you actually start making money. I do not care if Kevin Warsh reduces the annual meetings from 8 down to 4. I do not care if they change the inflation metric. None of those adjustments alter the fundamental mathematical law that spending less than you earn and investing the difference into productive assets over 40 years makes you wealthy. The people who are currently crying about the end of the dollar are the same people who bought gold at the peak of the panic because they assumed the good times would never end. They built their entire financial existence on the assumption of permanent economic collapse, and now they are paying the price for their lack of vision. Building a resilient portfolio means planning for the worst-case scenario while remaining completely passive. If you have to check your portfolio more than once a month to make sure you are not going broke, then you've failed at structural asset allocation. You are letting your emotions dictate your financial future, and emotions are the fastest way to turn $100,000 into $20,000. Look at the reality of the global economy right now, with energy prices spiking and global supply chains remaining highly volatile. You cannot solve a structural geopolitical inflation problem by simply manipulating short-term interest rates at a desk in Washington. The market knows this, which is why long-term bond yields are staying high despite all the political pressure to force them down. Investors are demanding a premium because they know the purchasing power of the fiat currency is being eroded by massive sovereign deficits. When the government has $39 trillion in national debt and is forced to borrow more money just to pay the interest on the existing debt, you are witnessing a structural trap. The only logical response as an individual is to acquire real assets that cannot be inflated away by political decree. You want to own pieces of global businesses that possess real pricing power, because when their input costs go up, they simply pass those costs on to the consumer. Index funds give you fractional ownership of those exact businesses without requiring you to do a single minute of corporate research. You do not have to read balance sheets. You do not have to evaluate executive management teams. You do not have to guess which product line will succeed next quarter. You just sit back and let the collective intelligence of the free market do the work while you focus on increasing your primary income. The obsession with finding the next big thing is a psychological disease born out of laziness and envy. People see someone on the internet make $1 million off a speculative asset, and they immediately feel like they are missing out. What they do not see are the 99 other people who lost everything, doing the exact same thing. The human brain is structurally wired to focus on the outliers, while completely ignoring the baseline statistical reality. My baseline reality is that I am 27 years old with $150,000. That is compounding quietly without requiring my daily attention. I do not wake up stressed about market futures. I do not look at pre-market trading data. I do not care if the stock market drops 30% tomorrow, because a 30% drop just means my automated monthly investment buys 30% more shares for the exact same amount of cash. That is the definition of turning volatility into an advantage, but you can only execute that strategy if you have the psychological fortitude to leave your accounts alone. Most people simply cannot do it because their self-worth is entirely tied to the daily fluctuation of their net worth. They feel like geniuses when the chart is green, and they feel like failures when the chart is red. That emotional volatility is far more dangerous to your wealth than any policy change Kevin Warsh could ever implement. If you want to win the game of personal finance, you have to detach your identity from the market entirely. Treat your investments like a utility bill that gets paid automatically every month, and then go focus on something that actually brings you fulfillment. The entire narrative around this secret gold run is being blown out of proportion by people who need content to fill a 24-hour news cycle. Yes, it is strange that central banks are hoarding gold. Yes, it is unusual to see reporting discrepancies in the London vaults, but your daily financial decisions should remain exactly the same regardless of what sits in a treasury vault. You still need an emergency fund that covers 6 months of living expenses. You still need to maximize your tax-advantaged retirement accounts. You still need to avoid high-interest consumer debt like the plague. These rules do not change based on whether the gold price is up or down. They are universal principles that have stood the test of time across multiple centuries of economic history. The people who survive the upcoming economic shift are the ones who accept reality as it is, rather than how they wish it would be. They do not base their investment strategy on the hope that the government will bail them out with low rates. They adapt to the higher for longer environment by cutting unnecessary expenses and increasing their savings rate. It is a cold, brutal process that requires you to sacrifice short-term dopamine for long-term security. But the alternative is spending the rest of your life trapped in a cycle of financial dependency where your survival depends on the whims of a central bank committee. I prefer to take control of my own balance sheet by keeping it lean, efficient, and completely detached from the speculative mania. When you stop trying to be smart and start focusing on being disciplined, you will find that wealth accumulation becomes an inevitability rather than a lottery ticket. The new monetary regime of 2026 is going to weed out all the tourists who thought investing was an easy game where everyone wins. It is going to punish the over-leveraged real estate syndicators, the speculative tech day traders, and the people who use their homes as an automated teller machine during the zero-rate era. But for the patient investor who kept their cash ready on the sidelines and maintained their monthly index fund allocations, this period will simply be remembered as another historic buying opportunity. Stop overcomplicating the situation. Stop looking for a secret strategy that does not exist. And just let the flat, boring reality of compounding interest do what it has always done. You do not need to be an expert to build an extraordinary life. You just need to have the discipline to execute an ordinary plan for an extraordinary amount of time. The market will eventually stabilize, the political noise will eventually fade away, But the choices you make today regarding your savings and your debt will impact your trajectory for the next 40 years. Choose the boring path to freedom because the exciting path usually leads straight to financial ruin. Just automate your systems, ignore the commentary, let your cash yield its guaranteed return, and allow your broad market index funds to grow quietly while you enjoy the view from your own sideline. Your future self will thank you for ignoring the headlines and staying the course. Building wealth is not about being clever in a crisis. It is about being consistent in a world that wants you to be reactive. Do not trade your long-term security for a short-term adrenaline rush. Keep your allocation simple, keep your costs low, and stay focused on the only thing you can control, which is your own discipline. While the world chases ghosts and gold vaults, you will be building a fortress of index funds that will eventually pay for the rest of your life. The game of money is a game of patience, and those who lack it will always be the ones who fund the gains of the disciplined. Let the central banks play their game of secrets, let the media push their narratives of scarcity, while you quietly accumulate your shares and wait for the decades of compounding to deliver your true freedom. In the end, the only thing that matters is how much you have kept and how much you have grown. Everything else is just background noise designed to distract you from the simple path to a wealthy life. Stay lazy, stay boring, and stay the course. The results will speak for themselves when the dust eventually settles and everyone else is still searching for a magic solution that never existed.